If somebody is drilling a little pocket, that doesn't interest me. I want to make sure that these guys can step out and demonstrate size.
Beta can give you 200 or 300% returns, which at 73 satisfies almost every level of greed I have.
Welcome back to the Vancouver Resource Investment Conference.
It is great to see you all here today. I want to kick things off with discussing the current environment for financing in the mining sector, because it wasn't too long ago that companies were having a very difficult time getting financed, and now we're seeing oversubscribed private placements and a lot of funding coming into the mining sector. So let's kick things off with how you see the health of financing in mining right now and how you see it evolving moving forward. Adrian, let's start with you on this one.
Yeah, there's no question that there's been a change, and I'm sure all of us on this panel and many of you, we're getting emails every day, 5, 10 emails for different financings. I would say two things. One is, generally speaking, I don't think we've reached a really crazy stage. You know, you see companies financing, and you say, I wish they didn't take so much money, and they go out for 12 and they're offered 18, so they accept it. I don't like that. But I don't think we've reached a stage where really bad companies are able to get money easily. The second thing I'd say, so that's healthy for the gold market. The other thing I'd say is, in my experience, certainly with my clients, yes, if the new deals are getting financed, but people are selling other things to buy the financing, which I don't like either.
And Maria, you're Senior Portfolio Manager and Chief Investment Officer at Sprott Asset Management. When you're evaluating companies that you're thinking of deploying capital into, how do you look at the way that the company is structured in terms of how they're doing financing, how they're approaching debt? What are the things that you look for, and how do you approach that?
Well, it certainly depends on the stage of the company, be it exploration, development, production. But if we talk about funding exploration companies, and really in the current environment, and I think somebody said this in the prior panel, production companies are making so much money right now. In fact, they're buying back stocks, they're paying dividends and increasing dividends. So mostly we're looking at exploration stage companies' financings. And in that, there's many factors we look at. I actually think that when a company takes more money than they go out to take, that's a good thing for an exploration company. Take it when it is there and put it in the ground. I think putting money in the ground is the most important thing for our industry, and I'm happy to see this lively environment when companies are able to find investments from investors. I think we're in a great place right now. I think this will fund the next generation of mines, the next generation of projects, and I'm actually quite excited about that. But in terms of what I look for specifically when somebody comes to me with a proposal, I usually ask who else is participating in the financing. Is there a warrant? Is there a hold period? How much money is management putting in? Importantly, to me that's a very important part. Is management putting their own money behind their projects, or are they just trying to sell me a bag of goods?
I think those are some very great points. And Rick, I'd love to go to you now as somebody with so much experience in the industry. How do you approach how companies are raising money, and your thoughts as well on management having skin in the game, both through insider ownership of the company and also participating in these financings?
So let's do it backwards. Skin in the game is important. I don't want to back professional management. I want to back partners. I was on a panel earlier today with Ross Beatty and Bob Quartermain, and I know that anytime they ask me for money, they have a substantial portion of their net worth in the offer, and they're going to participate in the offering, which is to say, I'm kind of a junior partner. Other people, companies that are populated by the lame, the halt, and the blind, perhaps they can't afford to participate. If they haven't made any money before, why would they make me any money, As to when to take the money, in a very generous market like this, you have to take money. Most of the positions that I have now, I've owned for 2 or 3 or 4 years. Mercifully, I own them at substantially lower prices. And it's likely that from my point of view, a financing that takes place today isn't dilutive, it's accretive. In other words, I get to leverage, because of my earlier participation and my familiarity with management, I get to leverage off the money that's being taken now. You know, Jesse, this is a capital-intensive business. If you don't have any capital, you don't have any business.
And Alexandra, I'd love to put the question to you in terms of companies diluting and the ways that different companies are raising capital. How to know when it's okay to dilute in certain situations, and how to know when a company is perhaps doing it too much.
You know, we're a little bit different in how we invest as a royalty and streaming company. So I'm mostly investing in development companies or actual producers looking to expand and restarts. So a lot of the dilution would probably happened up front. There are ones who are out there diluting, and that's hard. They've gotten through their expiration by dilution. They've found something, but now they actually want to build it, and that's where you can bring the streaming or royalty finance to help them alongside perhaps some equity and some debt, and do that kind of combination.
Well, let's expand on that for a moment, because of course you are the CEO and president of Empress Royalty. So let's talk a little bit about the royalty and streaming model. Perhaps from an investor perspective, what makes it an attractive way to invest in the mining sector? And perhaps if you could shed some light on Empress Royalty and your approach to the space.
Yeah, thanks. I'll keep it pretty quick. So Empress Royalty, we are a royalty and streaming creation company. We directly invest into mines, as I said, to get them into production or help them expand on that. So we're very much partners with the mining company. We need them to be successful for us to be successful. And as a shareholder, you're getting a diversified portfolio. We're pure gold and silver, so you're getting that exposure. And we're very much focused, as I said, on those assets that will bring revenue into Empress, so we can redeploy without further dilution to our shareholders.
Great, and Adrian, I'd like to move now to evaluating mining companies, how you all approach that. We could speak about a bit more of a holistic view, which I'd love you to touch on, but then also specifically in terms of financings, in terms of debt structure, share structure, what are the things that you're looking for when you're taking a look at a company in the mining sector?
Yeah, no, good question. For me, there's different metrics, different things I look at depending on the stage of a company. So for the major producing companies, free cash flow is the metric that for me is the most important metric, bar none. Of course, when you're looking at exploration companies, they don't have free cash flow. But for all companies at all stages, whether it's a major royalty company or a tiny exploration company, management is absolutely key. And, you know, you only have to look at the major mining companies to see, even at the major mining companies, the management makes a huge difference. So management is key to me, and this is why I think shows like this are so wonderful, because you have the opportunity to go around and actually talk to companies. I will never invest in a company if I haven't spent time with the company CEO. And by spending time, I don't mean just a half-hour Zoom call talking about a company. I mean getting to know the person, having coffee with them, having dinner with them, going on a mine site, just getting to know the person is paramount for me.
And Maria, I'd love to get your thoughts here as well, as somebody who's actively investing in the mining space from an institutional point of view. How are you evaluating the opportunities that are out there right now? Because obviously there's so many of them, as we can see at this conference. There's so much increased interest in the space, and thank you to all of you to coming out. It's a packed house, which is great. So for an investor out there who could maybe get some insight from your perspective, how are you approaching evaluating different companies in mining sector?
So we manage various portfolios. We have mutual funds, we have actively managed ETFs. So we kind of come at it from a holistic perspective. We can't just invest in early stage exploration. So we need to have, a bucket for producers, a bucket for developers, and a bucket for exploration. On the exploration side, to me, management is very important. But to me, I also, Eric Sprott taught me always how big can it get? So I always try to think, it's a favorite question, the prospectivity of a target. If somebody's drilling a little pocket, that doesn't interest me. I want to make sure that these guys can step out and demonstrate size. Because again, what are we looking for? We're looking for something that can become a big mine. So size is important, grade is important, how rich it is, and there's obviously where the project is located, geopolitical, fiscal stability, all those things come into place. But I would say for me, if you wanted just one thing besides management, it would be kind of that grandiose, how big of a mine can we build here?
And Rick, talk to us about why in the current environment for gold and silver miners, it's often best to go with the biggest and the best. We've had this conversation several times, and you choosing beta over alpha in this current market environment. So could you talk to us about the difference between beta and alpha as you define it in the resource sector, and why it's important to maybe go with the big producers?
I define beta as the outperformance of a sector relative to the broad market. So the outperformance of the gold equities is an example relative to the broad market. I define alpha as outperformance in your sector. Two different things. Watching bull markets now, I'm embarrassed to say for 50 years, what I've learned is in a secular bull market in resources, beta can give you 200 or 300% returns, which at 73 satisfies almost every level of greed I have. I'm not sure that I need to take the single company alpha risk if I can get 200 or 300% on beta, particularly coming off a year like 2025, where my expectation was 30% and my realization was 150%. One learns to temper one's greed when life has been too generous. The second thing I would say, and the exhibitors will hate me for this, but if you look at the length and breadth of the junior sector, I suspect that 85% of the issuers worldwide are literally valueless, which means that you have to be good enough at stock selection that you can pick 15% of the universe to generate your alpha. So don't get me wrong, all of the money that I invest prudently, I made speculating wildly, but I was a younger man in a different environment. And I would just suggest that for many people who want to have lives, they have kids or grandkids, they want to read books, 75% of your portfolio in beta and 25% in alpha is not a bad rule of thumb, particularly given that the rewards to beta are so incredible. If you look last year, if you just owned Agnico Eagle, Franco, and Wheaton, if you took zero company risk, zero execution risk, zero risk, you were up triple digits. One wonders why you drag one's carcass to all these shows, which I do, in order to expose yourself to a bunch of risk when you can get a double owning the best of the best.
And two of those companies you mentioned, Franco-Nevada and Wheaton Precious Metals, are in the royalty streaming space. I want to continue moving in that direction because I think for investors who are new to gold and silver mining, that royalty and streaming is one of the most attractive ways to invest in the sector. So Alexandra, I'll turn to you now again. Perhaps for those who are newer to this space and who are wondering why royalty and streaming is perhaps a better way to go, or they can be used with selecting individual securities, what would you say there?
So just taking a step back, a royalty, came from the kings owning the land, and someone mined it, and they received a royal right to a portion of the production. That expanded, it became more commercial with Franco-Nevada. That got even further expanded into a real financial instrument with Wheaton Precious Metals. So you've got the royalties taking a percentage of revenue, a stream, you're taking a percentage of gold or silver from that production. So as a streaming and royalty company, we don't have the operating costs, the capital expenditures like a typical mining company. and we're able to get that gold and silver into the company. And there's many different types of royalty and streaming companies too. There's prospect generators, there's a whole bunch of groups who are buying existing royalties that are out there, and then there's ones on the creation side like us, where we're directly funding the companies.
And Adrian, I'd love to turn to you and get your thoughts on the royalty streaming model and how you approach it from an institutional side.
Yeah, well, obviously I agree with everything Alexandra said. I'll say one additional benefit the royalty and streaming companies have, and we'll just say royalties for shorthand, which people sometimes forget, is the broad exposure that you get by investing in a royalty company. At whatever stage it is, whether it's Franco or Empress, for the market cap, you're getting exposure to more projects than you would if you were investing in a exploration or a production company. Take Franco, for example, and I can't help saying this, shows my age, but I first invested in Franco-Nevada, believe it or not, in 1985. So, and that was the first gold royalty company. Well, in 1985, it wasn't even a royalty company. That came later, but if you look at Franco-Nevada, they've got revenue from over 100 projects. They've got non-producing royalties on over 400 projects. I mean, that is incredible diversification. And that's why when Cobre Panama, which was their largest single, that was a stream, their largest single asset, went belly up from 2 years ago, it didn't destroy the company. And that's a critical factor in the royalty companies.
And Maria, I'd love to get your thoughts as well and perhaps shed some light on position sizing as you approach it at Sprott in terms of allocating capital to the riskiest part of the sector, the explorers, and then up the ladder to the big producers and royalty and streaming companies, how you approach that.
Certainly. Well, of course, our portfolios are structured with mostly producers right now. And still, because again, we manage billions of dollars, it's not very easy to allocate a lot of money into the smaller companies. By default, you just can't, sometimes the company doesn't trade enough, you just can't deploy enough money. So we structured producers to explorers going down the line. And in terms of royalty companies, we certainly do invest in them. For me, it's a trade-off between valuation and this kind of diversification / lack of operational risk. And what I mean by that is, as a kind of rule of thumb, generally speaking, royalty companies trade at higher multiples than production companies and exploration companies. And in the current environment, we're seeing so many different opportunities in exploration and development that we just kind of, our funds follow that, if you know what I mean. So again, for us, certainly royalties have a place in the portfolio, but to varying degrees.
Great. Well, Rick, I'll end by opening the floor to you. Is there anything you want to discuss that we haven't yet mentioned when it comes to mining in 2026, who gets financed and why?
I mean, one of the things that you have to ask yourself at a point in time like this, when everybody's financing, is why. When a company, broadly speaking, goes to finance, what they're telling you is that your cash is worth more than their shares. And if you see a circumstance where there's 500 companies going out to raise money, you need to ask yourself why. How are they going to employ that capital in an accretive fashion? When Alexandra, if she went to raise money, which I hope she does in the next 90 days, she will be able to sit down and tell me what specifically she hopes to accomplish with that money. She is probably smart enough, maybe not if I get her drunk, to tell me what specifically she's going to buy, but she's going to tell me in a very broad sense how the money that she raises is going to benefit me as an existing shareholder. That's very different than the circumstance you usually have on the street. Usually, if you get right down to it, in a market like this, people are raising money because they can. Their biggest unanswered question really seldom now has to do with exploration. It has to do with whether they're going to get their salary in 2027. And while I can understand that that's of interest to them, I don't care much. So that's what I would suggest. this is a very generous capital raising environment. Companies have to raise capital to survive. As an existing shareholder, the management has to tell you why the return on capital employed, raising money now, is accretive to you as an existing shareholder. And if they can't, you have to sell, just like they're doing.
Fantastic thoughts from all of you today. Thank you so much. Ladies and gentlemen, please a warm round of applause for our panelists today. Enjoy the rest of the show. We'll see you again.